Hey, what's up, everybody? Today we're going to be breaking down support and resistance, and it's one of the very first things every trader learns, and it's also one of the things almost everybody gets wrong. So, most traders draw a single line on the chart, they watch price touch it, and expect a perfect bounce every single time. Then, when it doesn't work, they either give up on the concept entirely or they just keep drawing more and more lines, hoping one of them works. And that's not how this actually works, right? And by the end of this video, you're going to understand exactly why price reacts where it does, how to pick levels that actually matter, and the two mistakes that are probably costing you money right now. So let's get into it. So let's start with the actual definitions because I want to reframe how you think about these two words before we go any further. So, support is a price area where buying pressure has stepped in before. It's strong enough to stop or reverse a decline. And notice that I said it's an area, it's not price. And that distinction matters, and we'll come back into that in a minute. And resistance, it's the same exact idea, it's just flipped. So it's an area where selling pressure has stepped in before. It's strong enough to stop or reverse in advance, right? And here's the important part most beginners miss. It's not that price literally can't trade below support or above resistance, like there's, some invisible wall there. It's that real buyers or sellers have shown up to those specific price points in the past. And there's a reasonable chance they or other traders like them show up there again. So, right away, support and resistance isn't magic. It's just a record of where real money has reacted before. So, why does price actually react at these levels at all? And this is the part most people never get taught. And once you understand it, the whole concept kind of clicks. So, number one is trap buyers and sellers defend their price. So, if someone bought near a low and price comes back down to that area, they don't want to sell at a loss, right? A lot of the time, they'll hold or even buy more right around that area where they got in. So, that's what creates the real buying pressure. And number two is the stop order cluster at obvious levels, right? So, breakout traders place their stop losses just beyond obvious swing highs or swing lows. So when price gets close enough, all those stop orders start getting triggered. So it's like one after another, a domino effect. And that creates a real burst of volume right at that level. And this is exactly why you sometimes see a sharp spike through a level before it reverses, right? And number three, the same crowd is watching the same chart. Thousands of other traders are looking at the same exact candles that you are. So if a level is obvious to you, it's obvious to almost everybody else as well. And that shared attention is what makes the reaction happen. So it becomes a self fulfilling thing because everyone is watching the same spot and reacting the same way. So support and resistance isn't some mystical force, it's just human behavior and order placement repeating itself at the same prices. Now that you know why these levels form, here's the number one mistake: treating support and resistance as a single exact price instead of a zone. So, why does it need to be a zone instead of one price? Because of exactly what we just covered. Different traders are entering around the same general idea, not the same exact tick. And that stop hunt effect we talked about often pushes price a few ticks past the obvious level. So, before it actually reverses, because that's precisely where the stop orders were hitting. So look at this chart. Price comes down, wicks below what looks like the line, and a lot of traders panic exit right there because it broke. But look closer. That's just a wick, right? The next candle closes back above and reverses hard. That wick was the stop hunt we just talked about, and that's not a real breakdown. So the rule is simple: a wick poking through a zone means nothing on its own. What matters is whether price actually closes outside of it. So stop drawing a single line to the exact tick. Give yourself a zone between 5 and 10 ticks of room around any level. And not every wiggle on the chart deserves a line. So here's what actually makes a level worth marking based on everything we just covered, right? One, it's been tested more than once. Remember that levels form because real traders are defending real positions. So a level price has reacted at two or three separate times means more of that trap trader and stop order behavior has already played out there, right? Two, it lines up with the prior day high or lows, or even the session high or lows, or even a round number, because remember the third reason levels work, the same crowd is watching the same chart. These specific reference points are what most traders are actually looking at. So they naturally draw, the most attention to the most orders. Three is price reacts sharply when it gets there. So a fast, clean rejection tells you real size showed up and defended that price immediately. Price slowly drifting through that level tells you the opposite, right? It's basically showcasing nobody's really defending that level. So if a level checks two or three of these boxes, it's worth marking on your chart. If it only checks one or none, leave it off. It's just noise. So let's pull this together with a quick example because it's easier to see than just to hear. Say price has been selling off for a few candles and it's approaching yesterday's low. That's already one of our reference points from the last slide, so it's worth having on the chart, right? Price gets there, wicks slightly below it, and closes back inside. That's touch number one. And remember, a wick alone tells us nothing yet. So price pulls back up, it comes back down a second time, and this is the time it doesn't even wick as far through. It holds a little higher and it reacts sharply off the zone, right? So now we got two separate tests, both holding with a clean reaction on the second one. And that's the checklist from the last slide, right? It tested more than once, it tied to a real reference point, and it's reacting sharply. At that point, this has gone from just a random price on the chart to a level you can actually trust and build and have a trade idea around, right? So this is the reference point, right? We sell off. Here's the wick. We do get the push up. We do come back down right here. We make a higher low, and then we get that sharp push, right? That quick momentum shift. So that's what you want to see. So now let's move forward into two mistakes I see constantly. And honestly, I made both of these early on in my trading career. Mistake one is trading the touch and not the reaction. Like, so people enter the second price touches their level, right? No matter how it got there or what it does once it arrives. But the touch by itself means nothing, right? Like we covered, it's the reaction that tells you whether the real size is actually defending that price. So you wait and watch before you do anything. And mistake two, too many lines on the chart. If literally every swing high and swing low gets marked, you haven't actually identified anything, right? And your chart just turns into noise and you lose the ability to tell what's genuinely significant from what's random. So go back to the checklist from a minute ago, tested more than once, tied to a real reference point, and proven by a real reaction. All right, so let's recap everything. Support and resistance forms because of trapped buyers and sellers defending their price, stop orders clustering at obvious levels, and the fact that the same crowd is watching the same chart. So they're zones, they're not exact lines. So give yourself room, and the best levels are the ones that have been tested more than once, right? And always wait for the reaction and never trade that touch. So I hope this helps, and I'll see you in the next one.